A rebound underway, led by tech this morning, 30 minutes ago until the start of cash equity trading. I'm Dani Berger. Matt Miller is on assignment in Detroit. We'll hear from him shortly. Bloomberg Open Interest starts right now. Coming up, a tech revival. TSMC's strong outlook renews confidence in the global AI boom. Banks beat, Goldman stock traders post record revenues, while Morgan Stanley's debt bankers boost their business. Plus, my co-host Matt Miller joins us from Detroit with Ford's CEO as the automaker teams up with a Ford Formula One powerhouse, Oracle Red Bull Racing. So pumped for those conversations. I love F1, Matt loves cars. It is a match made in heaven. So that will happen throughout the show. Let me show you what some individual stocks are doing this morning, though. And the banks beat. And here's the result. Goldman Sachs falling by nearly 2%. Trading revenue better than expected. Beat estimates by more than $700 million. It went to an all-time high. They also increased their dividends. Expenses were a little bit more than expected, and it's had a huge run up. Maybe that's why it's falling. Morgan Stanley, it fares a little bit better in terms of this morning's trade. It also beat estimates. Its wealth unit adds more than $400 billion than expected. Those shares down about 0.5%. BlackRock, those shares are on the rise, up 1.4% in the pre-market. They saw an influx of client cash. It helped them reach a new record, $14 trillion in assets. Let's show you what tech is doing because I had a tough day yesterday. Today we rebound thanks to TSMC. The ADR's up 5.5% in the pre-market. A blowout quarter, increased their capex. It helps lift the entire sector. So the capital expenditures, which they are earmarking, $56 billion. It is much higher than expected. I want to continue this conversation because, again, it's helping revive all of tech. And joining us now is Caroline Hyde. Hey, Caroline. Thanks for joining. All right, so reviving all the tech trade after a really tough day yesterday. What did we learn from TSMC?
That they are upping their capital expenditure, that they are all in on this AI demand. And look, that they're being cautious. I think that was the sort of narrative coming from the CEO who walked the line very gently. And he sort of said, look, I've been anxious about AI demand too, but look, I'm committing $52 to $56 billion in my own investment. Would I be doing that if I wasn't doing that carefully? To give you a context, that's about a third up from the previous year. And it's also way more than you're seeing other foundries invest, like the likes of Samsung and Intel. So they're clearly seeing so much demand coming from the likes of NVIDIA. Of course, they're also making Apple and other sophisticated semiconductor chips for mobiles. And that's an interesting signal because we'd all been worried about the fact that the memory chips are way down in terms of, there's a crisis, IDC says, in the amount that are being currently produced. You're having to see consumer electronics prices go up, and that might hit demand, but not for high-end phones. So there's some commitment to the fact that we're likely to see still Apple doing well.
But what we've seen on the outcome of this is those memory chip stocks, to your point, have been rebounding. But I wonder if underneath the surface, that's what becomes the winners. It's the hyperscalers, because TSMC spending more, sure, shows that there's healthy demand from the hyperscalers, but it's ultimately those chips that have that supply-demand issue that benefits them.
Yeah, Micron's done incredibly well. SK Hynix has done incredibly well. All areas of focus went into this high-bandwidth memory chip, because that was where you needed for AI accelerators to go alongside your AMD, to go alongside your NVIDIA. And it therefore means they take their eye off the ball on other consumer chips, the normal memory chips that you need in absolutely everything that you use. There's then this crisis and this crunch, and that's why suddenly you're seeing prices being driven up. In many ways, it benefits Samsung that makes the memory chips, but also it hurts Samsung because they're selling the electronics that you put into it. We're going to see a pressure on whether Apple drives up the cost of its phones to reflect some of the internal costs, and it's going to hurt others out there. Look, no wonder you're seeing HP shares have just really been hammered throughout 2025. How are they going to navigate it in 2026? But you're right. Ultimately, this is all us still trying to get whether there's an AI bubble or not. That's really what TSMC is about. That's really why you're seeing a flying in tech stocks once again, because it's vindication that demand is still there. And also, remember where they're spending. They're spending in the United States. They're trying to get more globally diversified in their foundry. And a lot of this speaks to the Taiwan-US relationship and whether we'll get a trade deal there. TSMC is going to be crucial for that, how much money they get put into the United States on their foundries.
Yeah, really interesting point, Caroline. Thank you so much for joining this morning. That's Caroline Hyde, who, of course, will be on Bloomberg Tech in about 2 hours' time. Now, let's turn back to bank earnings because Morgan Stanley, Goldman Sachs, BlackRock, they all reported this morning. Joining us around the desk this morning is Bloomberg Chief Wall Street Correspondent Sridhar Natarajan. Shri, great to see you. I mean, take your pick. I guess the overall thing is you have these really big numbers, yet shares fall, what do you just make of the reaction to the earnings?
The market can be unforgiving, right? We're talking about the AI trade being back on, but to some extent, the bank trade has fizzled out. Look at Goldman Sachs' number. Phenomenal results across the board. Equities trading, best quarter ever. With an asset and wealth management, they've actually met and set new targets, which should be a positive for investors. And if you think about the big L that they've taken over the last few years, which was their foray into consumer lending, after finally ditching Apple Card and handing it off to JP Morgan, they're out of it. Again, that should be a tailwind. And yet it seems today investors seem to be focused on that operating expenses figure, which was up 18% from a year ago. And perhaps the thing here is that they are, to some extent, a victim of their own success. The stock was up nearly 70%. So even if you post really good numbers, the market wants to know you can continue maintaining that with a strict discipline and focus on restricting and keeping a lid on those expenses.
When it comes to Morgan Stanley, this is a CEO in Ted Pick who's really been pushing things like their debt and underwriting business. That did have a good quarter. Asset management, which also had solid results. So is this just more vindication that Ted Pick's strategy is working for the company?
Look, they've been slow and steady and deliberate about what they want to do, and if they maintained that strategy over the last 10 to 15 years, they've talked about this strong investment bank business and the stability of the wealth management business. If you look at their assets under management at wealth and asset management, it's now at $9.3 trillion. It was a few years ago when James Gorman talked about that $10 trillion goal, which truly seemed aspirational. Now they're knocking on the door to meeting that figure. Within investment bank, Ted Pick has been repeatedly talking about how we're in the early innings of a multi-year revival in the investment banking cycle. Look at their advisory figures this quarter, more than $1 billion. Debt underwriting, it was a phenomenal quarter for them. So if they have put the right players in place and they're capitalizing on opportunities, and if what Ted Pick says is going to pan out, that is, we're going to see this resurgence last for a while, then Morgan Stanley is really well positioned.
Does it seem like among all the banks that what they're doing is they're just grabbing an increasing slice of this pie that's getting bigger? Because we do expect deal activity to pick up. Or does it seem like there really is a tussle right now for market share?
It's interesting when you think about that question, not as an individual bank. Yes, the pie is expanding and everyone's benefiting from that. But if you look at the top of that pile, if you look at the top 3 or 4 banks, they are the ones benefiting the most. Scale is proving to be a huge advantage in the banking sector.
Which is why we're seeing more mergers too. I mean, just earlier this week with BTIG.
And you will continue to see more of that as Washington seems to have this benevolent look towards the banking sector. Banks realize that they have the muscle and the freedom to go out there and explore deals and get bigger, because those who have scale, those who have built that tech moat, those who know that now that they have all the infrastructure in place, they can capitalize across the board, and that's what they're doing.
By the way, you mentioned this, but do you think Goldman's feeling pretty smug at the moment that they got rid of their credit card business, just given the politics of the moment?
I wouldn't say smug at the moment, but because they've also had to endure a lot of difficult headlines over the last few years, and to some extent they'll say they feel like they're still meeting some of the difficult headlines today, because some analysts are saying they missed revenue expectations, even though Goldman is keen to point out that part of it is because of the write-downs they had to take related to their credit card business.
Right. At least, they won't be pressed on, what do you make of the Trump's push on this and what does it mean for your business? Hey, Shri, we're going to catch up with you later in the show. Thank you so much for joining Bloomberg Chief Wall Street Correspondent, Shri Natarajan. Okay, a check on futures this morning. It is a rebound, as we're talking about with Caroline Hyde. Thanks to TSMC, NASDAQ 100 futures up more than 1%, S&P up 0.5%. Russell 2000, which, by the way, hit a record yesterday, that's up just 0.1%. Of 1%. Let's take a look at some of the other movers on our radar this morning. Boston Scientific, they will be buying medical device maker Penumbra in a $14 billion cash and stock deal. Boston Scientific goes down 5.2%. Penumbra goes up 12.6%. Spotify, they're increasing its premium subscription price by $1 per month for just under $13, $12.99. Those shares go up 1.3%. Meanwhile, Coinbase, that's among the crypto stocks in the red after a Senate committee postponed a meeting to discuss the crypto market structure bill. Shares of Coinbase down about 1%. Coming up on the show, we're going to head to Detroit. Matt Miller is sitting down with the Ford CEO, Jim Farley, and Oracle Red Bull Racing CEO, Laurent Mekies. A conversation you don't want to miss. You're watching Bloomberg Open Interest. A rebound this morning. Thank you, TSMC, with strong earnings and CapEx guide. The NASDAQ 100 future session up 1%. S&P up 0.5%. Russell 2000 underperforms. But it hadn't been those big tech players that outperformed yesterday. In fact, they underperformed, dragging the overall index with it. And that meant that the S&P 500 equal weight index and small caps had a great day. Both are at records as investors rotate away from the tech trade. Joining me now, I'm pleased to say, is Truist CIO and Chief Market Strategist Keith Lerner. Hey, Keith, great to see you this morning. I know you have an overweight on tech. You like U.S. large caps. So when you look at a rotation like we've had to start this year, do you think it's limited in scope?
Yeah, well, Dani, great to be with you. It's been a little bit of time. The question you're bringing up is the main one we're getting right now. And the way I'm thinking about it, I think often people think about it's tech or this. And I think it's both. I think we have a global bull market underway. When I look at the percentage of global markets that are in uptrends, 100% of the ones we track are in uptrends defined by above the 200-day moving average. And then more specifically in the U.S., tech has been lagging, but that's really after it almost doubled the S&P off the lows until October. Now you've seen some of this rotation. I think some of this broadening theme that everyone's talking about does have some legs. But I also say longer term, it's hard to give up on tech. And I think the news from TSMC this overnight kind of really reinforces that as well.
It's hard to give up on tech, but Keith, if you're just holding the index, let's say, this is something that Torsten Stock from Apollo has pointed out. It does have just a lot of concentration on hyperscalers, on AI, and Mag 7. That's not revolutionary at all. But if it is a broadening out trade, does that mean you don't want to hold something that's market cap weighted, that you want to make sure that you are owning the rest of the market nearly, if not just as much as some of these tech names?
Yeah, I point out last year, tech outperformed, but only 2 of the 7 Mag 7 actually outperformed. And what happened was the ones that outperformed really outperformed, and that drove the index. So the way we're thinking about it is, again, kind of a little bit of both. So last year, our legacy overweights was tech and communications. We still have that. But in December, we upgraded industrials to an overweight. That's based on this economic uptick that we're expecting. We also upgraded healthcare a few months ago. That's based on huge underperformance. A little bit of good news can go a long way there. And then also, after being more negative, we upgraded small caps last year as well. So again, so you don't have to kind of react to each of these moves. As you mentioned earlier in the show, like these markets are all kind of pressing on 52-week highs. Broaden out. It's not just tech. Broaden out your exposure. But again, I would still have some of that tech exposure in portfolios.
And you also still like gold as a diversifier, Keith. Why does that have more room to run?
Yeah. So I mean, we were positive on gold all last year, and honestly, I will say I am getting a lot more questions about gold and silver than we've had really in the last 10 years. It makes me a little bit nervous, but I would say that part of the reason why we still like it is the way it's acting from a portfolio diversification standpoint. We looked last year and said, okay, on days when the stock market and the bond market are down, how is gold holding up? More than 50% of those days when stocks and bonds were both down, gold was up. So it still has that positive diversification side. And then we look at historical cycles. It also suggests you have more upside. And we all know some of the fundamentals around central bank buying, the geopolitical side. And it's still a bit of a hedge against the U.S. dollar.
You have seen, though, a lot of the statistics and data show that you've seen more retail buying of things like gold and silver. Keith, just broaden participation in that market. Does that make you nervous at all?
I think we're more of retail coming into there doesn't necessarily make me nervous. I think what makes me a little bit nervous is just how extended some of these moves are. As an example, it's hard to bet against these things because the momentum's so strong. But when you look at silver on a 3-month basis, I believe it's up about 80%. We've only seen that a couple of times over the last 30 or 40 years. And the only thing that I think retail or just any investor should be aware of, it's hard to time when you have a pullback, but those pullbacks can be sharp, and you can see something like 10, 15%, pretty quickly. Again, in the context of a big move. So that's the way I just think the risk reward becomes a little bit, not a little bit, but less favorable as you kind of get the rubber band keeps getting stretched and stretched and stretched. Longer term trends are positive. It's just more of a short term view.
Keith, we're going to come back to you after the market open. That's Truist Keith Lerner. But for now, let's go to Detroit, where Matt Miller is sitting down with Ford CEO and Oracle Red Bull Racing. Matt.
Very much expanded. I want to welcome our Bloomberg Television and Bloomberg Radio audiences to Michigan Central Station here in Detroit. I'm sitting down with Jim Farley, the CEO of Ford, as well as Laurent Mekies, who runs the Red Bull racing team. It's a pleasure, gentlemen. I'm very excited as a fan of the brand and the league. And let me start, Laurent, with you, because you've said that this is the steepest hill F1 has ever had to climb. New regulations this year are sweeping. It's not just a tweak here and there. And you're starting with a brand new partner with Ford, who is going to build the engine with you as a collaboration. Why choose Ford as a partner?
You know, at first, you're right. You know, it's the biggest regulation change probably in the history of Formula One, at least in the modern history of Formula One. And it's also on that very same year that we chose the, let me say, crazy challenge to go and build our own power unit. And if you do that, you want to partner with the best. And we are in a lucky position where we have managed to strike this strategic technical partnership with Ford in this crazy adventure of building from absolutely zero our own power unit, and we go together in these new regulations.
Jim, for you, this must be exciting because you've built, honestly, a new legacy for Ford in terms of racing. I mean, on the one hand, you've got the new industrialized America here. On the other hand, you're going back to Le Mans with a hypercar in a couple of years. You're essentially doing DFV 2.0, right?
Yes,
this is like
yes,
the Cosworth of
yes.
old. Why do you, when you're talking to Bill Ford, when you're talking to the shareholders, how do you justify this spend and this, drive to go racing?
Well, a couple things. First of all, the tech transfer, this sport that Laurent leads, this team that Laurent leads, leader in aerodynamics, predictive failure components, and software control, the hybrid system, high discharge batteries. These are all core capabilities that we need for the next 5 to 10 years as a company. So the tech transfer is very relevant for us, like maybe 4 valves or overhead cams were in the 60s, But the tech transfer is totally different today. Formula One is a complete digital sport. And that's where we're going as a company, number one. Number two is, racing, especially in the off-road world, gives us credibility for customers that the product they buy has real capability that's been tested in a way that a brand who doesn't race can't say. And that's what Porsche and Ferrari knew for a long time, especially for us in the off-road world. This is really important. Racing is a fundamental part of our company's business because to beat all the great off-road brands and to establish ourselves, now we're 2x Jeep sales in the U.S., to keep that going and keep growing the off-road brand. Off-road racing in Dakar, Baja is where our customers will say, hey, that Ford has the real deal. It's the real deal. It's not a poser product. So racing is integral into our credibility as a company.
And you've obviously got a deep, rich history there, and you're bringing your software and battery technology, those capabilities to Red Bull Racing. But for you, Laurent, this is a whole new thing, right? Building the engine. I know you're getting a lot of help from Ford. What are they helping you with on the fuel side?
Look, they have been helping us on many different topics, and that list of topics is expanding every day. But let me give you a couple of practical examples. Jim's team have unique advanced manufacturing capabilities that we use to produce some of the most critical parts of our engine. And not only they're able to manufacture these parts for us, but also they do it in less time than we would do otherwise. And that gives us a crucial, our business is a time to market business. We call it a time to race business. And when we are able to manufacture complex components in a shorter amount of time at this incredible level of quality that we are looking for, that's a key competitive advantage.
Especially since I think you've said you gave up some time focused on last year's car, so you're in a hurry to make sure that this year, this new car, when Max gets in it in Bahrain, right, that it's a winner and not a learning moment. How do you make sure that you're winning straight out of the gate?
You will have to bear with us a little bit. The scale of the challenge is monumental. we have started to design and build these engines in what was a field. You know, we've made the factory, we've bought the dyno, we've put together an unbelievable group of people and group of partners, such as Jim and his team, and it will be foolish and naive to think that from the first day you are going to be at the same level than people that have been doing it for 90 years. So bear with us. It will give us a few sleepless nights. It will give us a few headaches. We feel we have the right people, the right tools, the right spirit across what Red Bull means and what Ford means. We'll eventually come out of top, but the first few months will certainly be full of learnings.
Jim, what can you bring back from this, I guess, laboratory, if you will, to the Ford customer here in America? Because yesterday we saw figures from the Bureau of Labor and Statistics that showed prices for the average passenger car, not Ford, but across the industry, are up more than $500. Prices for the average truck across the industry are up more than $1,000. What can you bring back that puts value into those price increases?
Well, Matt, I think Laurent said it really well. If there was an initial premise of what those transfer technologies would be to help the company, but what we're learning working with him over the last several years is actually that list is growing and it's more diverse than we thought. Of course, we thought it was aero and high discharge batteries for performance hybrids. Well, now it turns out performance hybrids are really important for the company. 25% of F-150 is now hybrid sales. People are buying it because of Pro Power on board, not just because of efficiency. And every day, honestly, the list of things that we can take from the effort with Laurent and his team, because the sport is so hard and the time pressure is so high, that list is getting longer every day. I could give you a long list, and most of the value that we're seeing on the tech transfer side are things that we didn't even have on the list when we started 4 years ago. It's a long list, but I would say that the real signature is, for me, is really the software. The control software for the hybrid system, predictive failure components, these are the essence of the new software-defined vehicle globally. To beat China, and they are really good, we need these capabilities from Formula One, and we can put them right in a transit van. He can help us with the, language models and the logic of predictive failure for a component on a Formula One race. We can use that same know-how, hopefully, to help our customers in a transit know that something's going to break way before it breaks. And that's the same capability he has to deliver for Max. This is really the cool part of Formula One. It is such a high-pressure, high-tech sport that actually the list of value, like lubrication, it's just going to keep getting longer.
Laurent, the President of the United States was with Jim a couple of days ago here touring their plants. As the U.S. turns more inward, it's interesting that you're participating in this sort of global sport, right? We've just learned of new visa restrictions on people from many nations, including Brazil. Do you find it harder to get people in to Miami, to Las Vegas, to Austin? I know there have been problems already holding up gear at the border.
Really, it's not an issue today. We are a global sport, as you have said. We are enjoying racing in pretty much every part of the world, or nearly every part of the world. We have incredible logistic capabilities, which is also something that we are brainstorming and exchanging with Jim and his team. And these teams, together with the help of Formula One, makes it very, very smooth to go around, and we back-to-back races from the US to the opposite side of the globe without any issue. So, it's a privilege that the sport have as a global sport to be able to move around very freely.
Jim, how are your discussions with President Trump? I know that you have pointed out in the past that the tariffs, as they're set up now, as they're designed, put you at a disadvantage to somebody, even an American auto manufacturer that produces in South Korea or Japan.
For sure.
I know you're going to meet with Jameson Greer tomorrow in the great state of Ohio. Have you had a chance to talk with the president? Have you made any progress in getting maybe carve-outs?
We're really encouraged. I mean, look, Ford is the most American car company. We produce the most hourly workers. We export the most. And so the administration's been great to work with. They always answer the phone. But there's a long list of things we got to work through. I think we've made progress on mitigating some of the tariffs, but we have more work to do. For us, we have a high exposure to aluminum, for example. The EPA changes are really welcome, frankly. And we're seeing that play out really in our business. Part of the reasons why our valuation is increasing is because people understand we can build more profitable vehicles now, and that's more employment in the U.S. But there's a long list. We got the USMCA coming up, very important negotiation for Ford. We need to change USMCA, but we built our entire vehicle business as an industry between Canada, Mexico, and the U.S. We have to get this revised, but it'll be very important. I think continue to work with the administration on tariffs, how we handle the China. You know, if you look at what's happening in Europe right now, in the UK, the Chinese are now quickly almost 10% of the marketplace, in electric cars even higher. They pose a lot of threat to labor locally. They have huge subsidies from the government that they're exporting. As a country, we need to decide what is a fair playing field from a cost. How do we handle, these vehicles? If we're scared of a balloon, you can imagine a car with 10 cameras that can drive itself. Yeah. These are incredibly sophisticated technologies, and when we deploy that in China, it has to be approved by their Defense Department because, those vehicles can be guided into all sorts of things. Well, we need the same, we have a good starting point for that philosophy of the ITC of the vehicle, the digital footprint. Now we have to, make sense of that for the China threat. I know that the president talked about that during his visit at the Economic Club. How do we handle Chinese cars? Now, his personal opinion was we should let them into the U.S., but maybe. I think we need to work through that as a company and as a country. I think there's always a lot of big topics for the car industry because it's so important for our country.
Well, we'll be covering all of those here in Detroit with you, Jim, and you, Laurent. Thank you so much for joining us. And the Detroit Auto Show is here. It's kind of like the Super Bowl for me, Dani. And by the way, I would be remiss if I didn't point out the cars behind us are a brand new release of the Ford Mustang. It's the Dark Horse SC, so a supercharged variant of the 5.2-liter V8. It looks like it's going to be an absolute monster.
So cool. Matt, thank you so much for that conversation. I'm also super pumped to see what the new Red Bull car looks like. Matt, you got like a look under the tarp or anything?
I have not gotten a look, but you know what? They probably wouldn't show us the actual aero. It's just the colors and the design. Everything is very, very hush-hush until they get the car out on the road in Bahrain.
Fair enough. Matt, thank you again for that conversation. More coming up, and here we are a few seconds into this market open. It is a market that is rebounding thanks to the likes of tech. Tech outperformance, NASDAQ up 1.2%, S&P up 0.6%. So can we recover from the down day? Opening bell, we have Yorkville. It is a SPAC. It's a SPAC. It's going to be alongside Truth Social and Crypto.com. It's going to be a digital asset treasury company, so one of those companies that buys some sort of crypto. So they all are very excited. Over here, I mentor a lot of wonderful young women, a few young men as well in the crowd here too. It's a company supporting National Mentor Month, which apparently it is, and mentors are great and important. So good to see them down at the NASDAQ. All right, let's take you to some of the individual movers this morning. We start with the bank stocks that have turned around from the negativity in the pre-market. Yay, they're finally up. Goldman Sachs trading revenue, a monster figure for them. They almost beat by $1 billion, to be more specific. It was $700 million, but that was an all-time record Wall Street for equity trading. It also increased its dividend. Morgan Stanley also having a great day here at the open. 2.5% is the surge they're seeing. Wealth unit, that adds more than $50 billion than that had been expected. BlackRock, they're also becoming even more of a behemoth of a monster in this market. They saw an influx of client cash that now means trillions. They are at a record $14 trillion in assets. Let's look at what tech is doing, because I mentioned that it is rebounding. TSMC, they reported a blowout quarter. It helps lift the entire tech sector. It's earmarking $52 billion to $56 billion in capital spending for 2026. All of that is higher than expected. Let's bring back Truist CIO and Chief Market Strategist Keith Lerner. Keith, banks for now rebounding, but the trend has been when these banking stocks have been reporting, they tend to fall immediately after their earnings just because expectations have been so high. Is this kind of like a blueprint for earnings this season where all equities have run up and expectations are really high?
No, I don't think it's for all equities. But to your point, if you look at some of these banks or investment banks that have reported this morning, I mean, over the last 2 months, some of them are up 15, 20%. So you go into the earnings season and people are expecting good news, you get it, and there's not it's not a surprise. And markets are all about how things come in relative to expectations. So I think it's normal that, you see a little bit of maybe some chops and consolidation. But I think the good news is if those earning numbers are strong and they continue as the economy upticks, as you see some M&A, I think after a consolidation, you'll likely see some of these areas start to rebound. But again, we really had a strong move heading into the earnings. And as your other question, I mean, we are seeing the average stock do better into earnings. But I will say, like, even with tech, I think actually tech, because expectations now have been reset lower, maybe set up for a positive surprise, just like we did on some of the semiconductors that we're seeing as well. And also, we have to remember, we've had a nice move for stocks more recently, but there was a lot of chop going on, between November and December before this recent move. So I think it will be a pretty decent earnings season overall.
Well, some of the recent chop, Keith, has been very much so policy-led. It's just this fire hose coming from the White House on all policy that has to do with affordability. It hits institutional home buyers, credit card companies, oil companies get caught up in Venezuela. How are you thinking about policy-induced volatility heading into the midterms?
Yeah, it's interesting. I was thinking if we had some of this news last year when President Trump came back into office, I think the market would have a much more severe reaction. But I think in some ways they're adapting, I should say, to the uncertainty that we're seeing more on a regular basis. And on each one of these, we just look at it and say, okay, what does this potentially mean for earnings? Like Venezuela as an example, it may mean something for the energy companies. It probably isn't a big mover overall for the equity market. So, but there is some difference, but it doesn't meaningfully change our view. Then the Fed investigation comes up next. We say, okay, how does that impact interest rates, inflation expectations? And so far, as we're saying today, interest rates are actually somewhat lower than that announcement came out. So it's things that we have to look at, but instead of just reacting, we're looking at, okay, how does that impact markets, and does that warrant a change? And so far, some of the things we're seeing hasn't really shifted our overall view, but we are in a midterm election year. Midterm election years tend to have more volatility.
I would love then to get your thoughts on Dan Ivison, what he said from PIMCO to the FT, saying it's important to appreciate that this is an administration that's quite unpredictable. What are we doing about that? We're diversifying. We think we're in a multi-year period of some diversification away from U.S. assets. Keith, given what you just said, it sounds like you disagree with that.
Well, I actually agree with the global diversification. Even though we still have this, U.S. bias, over the last 15 months, we have been increasing our international exposure. I mentioned we've got a little bit more cyclical, and we also, after being more negative on small caps, have increased that as well. So I think relative to where, say, folks were like 2 or 3 years ago when, clients, investors would say, why am I investing in anything besides the S&P 500? We have a much broader playing field. So I think that does make sense. But I would just say I wouldn't necessarily give up on the U.S. The U.S. at this point still has the strongest earning trends globally, and I think still warrants some decent exposure.
You mentioned also the criminal investigations into the Fed, into Chair Powell. Were you surprised at all that that didn't have a bigger market impact this week?
Yeah, I would say if you gave me the headline the day before and said, what would the market be up, I would probably say no. And I think that just goes back to, I think last year, and maybe it's a good or bad lesson, but there's recency bias. If you think about last April, we had the tariff shock. There was a lot of selling that was happening, and the markets rebounded. So I think investors now, when they hear these headlines, instead of just automatically reacting, they're taking a step back, remembering it wasn't the right thing to do last year, and they're just being a bit more patient and say, okay, what does this really mean? And over time, some of these things could play into markets, but I think it's just a little bit of a less reactive market to the policy changes that we're having out of Washington, because some of it's policy changes and some of it's rhetoric, and I think that's hard to distinguish at times.
It's a really good point, right? And it's a lesson that we've continued to learn, especially after April 2nd. It's a market that learned that Trump will back off some of the worst of its tendencies. So if you see things like credit card companies, Visa, MasterCard, American Express sell off, are those dips that you want to buy then? Do you want to actively push back on some of the policy-induced selling?
Yeah, well, I think you take that in the context of like what the valuations are, what the relative price trends are. And then going back to the broader point, the way when I think about all of the different things that we've gone through the last year, and I call it the carousel of concerns, right? As one concern recedes, another pops up, takes its place. But if you zoom out a bit and say, okay, well, what's driving this market? Well, forward earning estimates are at a 52-week high, and they continue to make 52-week highs. So, yes, if the earning trends are still in place, and we like, how it fits into our overall theme of this economic uptick, then I think there are some opportunities as a result of the headlines.
Keith, not only just, overall earning estimates look really good, margin estimates also look so strong, coming off the back of already record margins for the S&P 500. How is that possible with corporations still dealing with tariffs? I feel like that's been one of the big shockers of 2025 and kind of still is for 26.
Yeah, no doubt. I think if you think the last few years, a big part of that margin expansion was really tech and AI driven. So the big question for this year, and we're seeing some signs of it, is are we going to see the AI adoption that drives efficiency? We just saw really like 2 blowout productivity reports more recently. And then if you think about the 493, like the margins there have really not expanded that much. But at this point, if you think about companies that have a lot of fixed costs, labor costs, actually at this point, as they adopt AI, there's room for those profit margins to actually expand. So if tech's margins maybe come in a little bit because of the competition and the 493 come up a little bit, I think you could actually still hold relatively healthy margins for the overall S&P. And that also, I think, speaks to the overall kind of broadening trend where we're seeing earnings move beyond just tech, but also to small caps, the equal index, the financials, industrials, and so forth.
Hey, Keith. Awesome. As always, so great to have you on. Truist, Keith Lerner, please come back again soon. All right, let's get a check on your equity market right now because it is a rebound after losses yesterday, higher by 0.5%. The things that did bad yesterday are doing pretty dang well today. It is tech. It is NVIDIA, thanks to just its overall size. It's the thing that's lifting up the overall market. NVIDIA, Broadcom, Applied Materials, a lot of these chip companies having a really, really good day. Lam Research, why is that? It's because TSMC is spending more. There is a supply-demand imbalance for chips. Prices can continue to go up for them. So Micron doing well, Amazon, AMD having good days. To the downside, healthcare not doing as well. Eli Lilly, that falls. Boston Scientific down 5%. That's largely due to a little bit of M&A that they're doing. The acquire tends to fall with the extra costs that go there. But again, it is just a lot of healthcare not doing well. P&G, consumer staples there, Merck not doing as well too. The energy companies also having a tough day. If you look at what the sectors are doing, in fact, energy is the worst performing sector here. About 10 minutes into the market open, energy falls 1%. About midday yesterday, they were having a good day over fears of geopolitical tensions in Iran. President Trump diffuses some of that, so oil falls. It was down about 4% last I looked for oil, so hence the energy players not doing well. But again, you can see Infotech at the top of the pile, largely thanks to the fact that TSMC had earnings and the rotation kind of undoes itself. Financials doing well, and coming up, we're going to talk about that. Goldman Sachs revenue smashes Wall Street records. Their traders having an incredible quarter. We're going to discuss with our Bloomberg Intelligence financial analyst, Neil Sipes. That's coming up next. Stay with us on Bloomberg Open Interest. Let's get some top calls, some of the analyst action, the upgrades and downgrades from the sell side this morning. KeyBank, they downgrade Rocket Lab, saying the company's key growth catalysts are no longer a surprise, leaving little upside. Shares fall 2.5%. Next up, Barclays, they upgrade Dell to a buy. They cite accelerating demand for AI servers and growing opportunity across server and storage markets. They also say that Dell's supply chain gives it an edge in navigating a challenging commodity environment. Shares up just under 1.7%. And finally, Wells Fargo, they downgrade Flutter Entertainment, saying the stock looks less attractive thanks to slower betting growth and heavier promotional spending. Shares fall 0.7%. Let's turn back to bank earnings. They've mostly topped estimates this week. Let's bring in Bloomberg Intelligence financials analyst Neil Sipes. Neil, the good news is finally the bank stocks are rallying after their earnings with Morgan Stanley and Goldman. I'd love to get your take just on those two this morning.
Yeah, so I think for Goldman and Morgan Stanley, it's a story of robust momentum across the fee and flow franchises. So we're talking capital markets, that's the investment bank, the trading, as well as the wealth management, which both of them are really trying to emphasize as that steadier, more recurring revenue to complement something more cyclical like the capital markets. So, we're seeing trends that are really strong in equities trading. You've talked about the Goldman number that they posted this morning, really strong there. Better performance there in Morgan Stanley than consensus as well. And that's generally been a trend across the banks that have reported strong equities trading, outperforming fixed income. Investment banking, a little bit uneven in the fourth quarter, but broadly the expectations moving forward, 26, even 27, is more activity. Credit markets are open. M&A is going to pick up. Valuations certainly at this stage support ECM IPOs, so we'll have to wait and see, but things are certainly good, and it's almost like strong results today, but even better days ahead.
It's true, but I guess how much of that was surprising, right? How much of that did we already know? And just given what's already priced in to these stocks, do you think there were any of these earnings that maybe didn't fully justify the run-up that they've had? Or is it like, yay, good job, banks, you justified it?
I think it's a good point because the bar was pretty high, right? And everyone's pretty much expecting what we just talked about for 2026, which is a further pickup in this activity and at least resilient trading. So the bar was pretty high. In aggregate, we're beating those revenue estimates in that high bar. So in some sense, that's a positive. And again, the 26 outlook is constructive. But to that point, when you pull valuations into it as well, and the performance that these banks have had over the past year, perhaps a little bit of a breather post results, but the underlying fundamentals, the underlying numbers, and the outlook, all positive.
Are expenses a problem? One of the narratives that arose after Citi, JP Morgan, and Wells Fargo was that sure, results were good, but expenses were worse than expected, and that's part of the reason they sold off. Is that a problem, especially if banks are trying to invest in productivity and AI tools that mean they don't have to spend as much elsewhere?
Yeah, I think when you hear spending, it's nice to hear that there's efficiencies down the road, but obviously you have to spend up front. And I think you have JP Morgan sort of leading the way, as they always have, in terms of investment. And that sort of creates a trickle-down effect for everyone else to have to invest and keep up. It feels like, that's maybe more of a story for some of these large traditional banks like a JP Morgan with large consumer and commercial-facing franchises rather than the capital markets and wealth management businesses. But nonetheless, there's an increasing need to spend, particularly in this age of AI and technology. So that's something that we're going to have to continue to watch. I think they're leaning in as the revenue environment looks pretty constructive, right? So it's the idea that not all of that revenue upside in 26 and maybe beyond is going to flow to the bottom line, but rather you're going to have to share that with some investments and expenses that in theory over time are going to bring those returns up longer term.
By the way, do you think with all of this, Goldman is pretty pleased with themselves that they've gotten rid of their credit card, their Apple credit card business?
Yeah, I think this is a nice check mark for them to sort of really start closing the book on the consumer business, which...
especially after the DC headlines is kind of what I'm getting at here.
Right, oh yeah.
That also helps.
For sure, and obviously there's plenty of questions about how that would actually look if ever implemented for the credit card cap. This is also just a tiny business for Goldman Sachs, much more meaningful for someone like Citi or even Capital One. So yes, maybe even more of a relief that that business is now leaving, and they'll continue to focus on the core, and that's capital markets, and that's where you want to be.
Neil, thank you so much for joining. After a solid set of results from the banks, finally a rally underway. That's Bloomberg Intelligence financials analyst Neil Sipes. Coming up, TSMC's monster quarter revives confidence in AI trades. More on tech. That's coming up next. This is Bloomberg. You are watching Bloomberg Open Interest about 20 minutes into your trading day, and it is a rally after yesterday's losses. S&P goes up by about 0.5%. Tech outperforms. I'll show you some of the individual names in a moment. Small caps, they closed at a record yesterday, so we were trading at another record this morning. We also had the equal weight measure close at a record yesterday, so we're also on track for that. Okay, some of the individual stocks. We are seeing banking stocks finally rally. The theme had been banks post really good numbers. They beat on all expectations pretty much. Maybe expenses are a little bit worse, but they fall because of high expectations. That's not what we're seeing. We are seeing that beat, and we are seeing a rally. Morgan Stanley up 3.25%. Goldman Sachs up 1.25%. By the way, I should also mention NYMEX crude falling a lot. President Trump downplaying some of the tensions in Iran yesterday, which is leading to that. The other big mover today, it has been tech. TSMC comes out with monster earnings. They raise their CapEx guidance by a large amount, beating expectations. So a lot of the memory chip stocks doing well. SanDisk, those shares are up 8%. They had a poor day yesterday. ASML up 6.7%, and NVIDIA up 2.7% too. Again, thanks to TSMC, it is the supplier of chips for NVIDIA. We're going to get more on today's tech rally. Let's bring in Bloomberg Tech co-host Ed Ludlow. Ed, TSMC results, just walk us through that. How big of a surprise to the upside were they?
It's big because TSMC is historically careful and prudent, right? You know, the capital expenditure range of up to 56 billion was well beyond the street's expectations. But C.C. Wei, the CEO, despite the sort of market rally that's come in response to it, was very careful to say, like, look, if we don't deploy this capital in a careful way, it will be a disaster. And the reasons are very important to discuss. Basically, any leading edge chip fab that you build is a fixed cost. $15 to $25 billion. And at the time you commit the capital, it takes many years to come online, and you can't know what the demand will be 4 years ahead of time, not perfectly. And so the risk is that because of the brutal economics of semiconductor manufacturing, if you're not getting a high utilization rate at the other end, the margins this industry is used to evaporate, and then suddenly that would be a disaster. So the market response this morning and the rallies we see, not just in TSMC's US listed shares that you're showing, but broadly AI adjacent names and chip names, is actually the near term demand is clearly there. They also gave us the evidence of 30% revenue growth in this year. But there are other factors to consider, like the other segments they serve. Smartphones, for example, make up a big part of their business.
I was going to say, Ed, isn't one way to also read this, the demand that TSMC has for all aspects, also bad for the likes of Apple, maybe even some of the other smartphone manufacturers, because it just means costs are going up across the board?
Yes, but at the same time, you know, the margins that we talked about, our fears of fading away, are currently intact because the capacity that they do currently have installed is at maximum utilization. And right now, the state of play across the industry, right, whether we're talking about AI accelerators with NVIDIA or processors for smartphone, is that demand is exceeding the industry's ability to supply. And so, you know, the data that we got in this print is a commitment to expand that capacity, both domestically in Taiwan, but of course here in the United States as well. The problem is, no matter how good you are, even if you're C.C. Wei, you cannot tell the market with a full guarantee what the demand will look like in 4 years from now. And in the background, particularly as it relates to smartphones, and to answer your question, there is a massive crunch on memory, the availability of memory, which has pushed prices higher, because the new factor is the demand for memory that's coming from data centers. At the end of the day, DRAM at its base level is common, whether it's going into a data center or it's going into a smartphone. And so that will be interesting to see how they manage their allocations from that standpoint.
Just, you know, on this idea that you don't have much visibility into the next few years. I mean, we can't really look at this one set of earnings and say, okay, it means that the arguments for a bubble are basically nil, because the hyperscalers have said that the risk is underspending versus overspending. Does it really disprove anything about this environment?
I'll throw some data at you that you're not prepared for, and I apologize. But away from the chips, look at the power. Look at PJM downgrading their demand forecast for data center related power draw, because what you have is commitments, on paper plans for data centers that aren't being built and don't have the electrification confirmed. Look at that data set, because actually the people are realizing there's a lot of people sitting on power contracts, not using the power and installing in the real world.
Yeah, a really good point. Ed, thank you so much. Bloomberg Tech co-host Ed Ludlow, who will be back in an hour for his show, Bloomberg Tech. Coming up in the next hour, Joyce Huang talks about the bond markets with a close watch of the Fed subpoenas. Plus, Carlyle's Shane Clifford discusses their foray into sports marketing, and we hear from Carhartt's CEO. Thirty minutes into your trading day, a rally underway led by tech. Welcome to Bloomberg Open Interest. I'm Dani Berger. Matt Miller is on assignment in Detroit. We'll hear from him throughout programming. Coming up, a tech revival. TSMC's strong outlook renews confidence in the global AI boom. Banks beat, Goldman stocks traders post record revenue, while Morgan Stanley's debt bankers boost business. Plus, we're going to head back to Detroit, where my co-host Matt Miller is speaking with the executives driving Ford's return to Formula One. Thrilled for those conversations. Now we begin with earnings. Morgan Stanley, Goldman Sachs, and BlackRock reported huge beats, showing that the capital markets activity remains alive and well. Joining us now is Joyce Huang, Senior Client Portfolio Manager at American Century Investments. Joyce, not all necessarily the banks themselves, but the overall signal for this economy. We usually like to dig through the earnings to try to get an idea of that. If you do have them being very bullish on M&A continuing, loan losses are low. They're continuing to loan more. Credit availability is there. Does it bring you with a bullish outlook for this overall market and American economy?
Hi, Dani. Yes. So our outlook is that a lot of the stimulus that's expected in the economy from the One Big Beautiful Bill effects, people are going to be getting tax refunds soon, that we expect to really facilitate more growth in the second half of the year. Now, in the first half of the year, we could see a little bit of a slowdown. Retail earnings were still strong. Consumer confidence is still very high, but we do expect that consumers may pull back a little bit just due to the uncertainty of the market in the first part of the year. However, we do see a lot of bullish impulses for banks, financials. It's one of our biggest overweights in our corporate sectors.
Joyce, I mean, just more broadly in what you're talking about of things like policy, One Big Beautiful Bill helping things. When does it get to a point from this sugar rush of tax refunds? I mean, desire of also giving Americans tariff rebate checks, maybe doing other measures like increasing defense spending by 50% of the budget. At what point does that get to be something that helps growth versus turns into something that looks more dangerous for inflation and catches the eye of this bond market?
Yes, so that is probably our concern, is that if the stimulus does get excessive and if the Fed is pressured to cut rates further than we believe is prudent, that could really lead to the worst case scenario where you have a huge bear steepening of the yield curve. So the way we're positioning our portfolios, we really like focusing on the short to intermediate part of the curve. So let's say 2 to 7 years. Further out, 10 plus, that is really going to be affected by the long-term deficit concerns, any sort of increase in inflation over the longer term. That's why we really prefer sticking with the shorter to intermediate part of the curve.
I did see some notes out there that maybe even a flattening could occur based on the White House's attacks on the Fed. And Joyce, the idea there basically is it makes Chair Jay Powell dig in his heels. He doesn't leave anywhere. Maybe he even becomes something of a de facto Fed chair, depending on who the president puts into that seat. And then you get the rest of FOMC officials also digging on their heels and pushing back against rate cuts. Could you see a realistic world in which that scenario unfolds?
I think that is extremely unlikely. I mean, I think what you've seen from President Trump and, the pressure that he's put on Jerome Powell as chair and the way that there has been attacks on other members of the Federal Reserve, I think people are a little bit cautious about, invoking the ire of the president. I do believe that once the chairman flips over in May, and we should get an announcement about President Trump's pick shortly, that's why we think that, there may be one, maybe two interest rate cuts left in this cycle, but most people are likely to go along with that. Inflation is inching lower for the time being. That is supportive of additional cuts. The Fed has cut 3 times since President Trump really launched his initial attack on Jay Powell last summer. So if we price in another 1-2 cuts, that's already a whole percent, maybe 1.25% lower than when we started. So I think that would probably settle things down at a pretty good terminal rate for this cycle.
I've definitely heard that as to why the markets didn't react more to some of the issues around Chair Powell and the subpoena being issued to him. Joyce, the other one that I've heard, and this is something Charlie McElligott at Nomura talks about, is that fiscal dominance is more important, not even for the U.S., but generally for central banks around the world, that it overrides any sort of monetary policy determinations and implications for that we are in an environment where debt is high, and that's going to be driving central banks. Is fiscal dominance, is this the theme of 2026?
I think for sure. And you've seen that really ever since 2020, right? Why did the U.S. grow much stronger than other developed markets? All developed market central banks cut rates basically to zero. But the U.S. was the only one that did the tremendous amount of fiscal stimulus that we've seen. And that's why U.S. growth has been so strong since 2020, right? Outpacing developed market counterparts 5x. So that's why I do believe that the fiscal effects, again, that's why we believe the second half of the year is really going to potentially accelerate due to those fiscal stimulus tailwinds.
Joyce, such a pleasure to have you on. Thank you so much for joining us this morning. American Century's Joyce Huang. Let's get a check on markets over 30 minutes into your trading day. The outperformance continues for tech. NASDAQ up just under 1%. S&P up 0.5%. Russell 2000 futures, those continue to trade at a record, with 10-year yields up about 2 basis points following a strong jobless claims coming out earlier in the morning. Now, when it comes to some of the single stocks on the move this hour, TSMC, this is the reason for tech outperformance, budgeting $56 billion at the high end for CapEx. It's a forecast that's fired up investor hopes of sustaining an AI boom. Boston Scientific, they're going to be buying device manufacturer Penumbra in a $14 billion cash and stock deal. Finally, Spotify, they are increasing its premium subscription price by $1 per month to $12.99. The banks also outperforming today. Morgan Stanley and Goldman Sachs, both shares are set higher after a huge blockbuster number from Goldman Sachs on their trading division. We also saw Morgan Stanley, most of their numbers coming in above estimates. Joining me around the table is Bloomberg Chief Wall Street correspondent Sri Natarajan on this. Sri, what was your take on the earnings this morning?
Well, the most important thing is no one at Morgan Stanley or Goldman Sachs has to worry about paying for that increase in the Spotify premium subscription price.
I think they can afford $1 more per month.
Look,
yes.
Across the board, the numbers were pretty good. We were scratching our heads a little bit this morning. In pre-market, we saw Morgan Stanley was down a little bit. Goldman Sachs was down almost 2%. And the numbers were better than what most analysts expected. Yes, on the Goldman side, you were focusing a little bit on operating expenses. But once markets open, and we've seen this TSMC lift that's taken every stock in the index up, you're seeing the outperformance in Morgan Stanley, you're seeing the outperformance in Goldman Sachs, and that seems to line up with the numbers. When they are producing strong beats across their investment bank, whether it's in deal making, advisory, DCM, ECM, or look at the trading business, $4.3 billion equities quarter for Goldman Sachs. That is a record, not a record for the fourth quarter, but a record. That shows you that things are firing on all cylinders. And the most important message that we are getting, at least from the analyst call that just kicked off at Goldman Sachs, from Ted Pick on the Morgan Stanley call was, this is still not near the end. We are still in the early innings. There is still a lot more room to run. And if that were to play out as Ted Pick believes, then these two banks are very well positioned to capitalize on that.
How are these banks talking about efficiencies and productivity? Because Goldman has, it's like 1GS or something, their platform with all the AI advancements they're making. Are they touting yet that investments in technology are paying off in terms of less expenses?
Look, and I've lost count at this point because I think we're at 1GS 2.0 or 3.0. But yes, they're all laser focused on that. We've been talking about technology/AI, how it's going going to affect headcount. You know, Brian Moynihan at Bank of America was talking about how they're just going to let headcount drift lower. That obviously is one very incredibly powerful lever that they can pull to keep a check on expenses. What we've seen over the last 12 to 18 months is a lot of talk about how AI will be powerful and beneficial, but not very specific targets on how much in cost they can take out. How directly is it going to affect your hiring plans, the new batch of analysts that are going to come through? I think over the next 9 to 12 months, we will get a lot more clarity on that front as well.
For the wealth management businesses, because of course we had BlackRock earnings come alongside of it, you know, the behemoth continues to be an even bigger behemoth. How much of these banks, when it comes to that business, are just riding this bull market, that they're just doing well because markets are rallying? Or is there something to be said of an increasing focus on private capital, for example, that's helping them?
Well, whatever be the reason, if it's the market's tailwind, great. The banks are still positioned to benefit from it. And like, it is an important business for them. Morgan Stanley printed a 31% pre-tax margin in its wealth management business. Goldman Sachs said it's going to raise its targets in its asset and wealth management business, again, the pre-tax margin target, to 30%. And right now, just about 2 minutes back on the call, David Solomon was asked about this. Where do you see growth for your wealth management business? And he said, we do have a really good footprint with ultra wealthy, ultra high net worth clients across the globe, but we're also seeing great growth opportunities in places like Asia and Europe. As those parts of the world continue to spit out more billionaires, you can be assured that the Goldman Sachs advisors and the Morgan Stanley advisors will be knocking on their doors.
Sri, such good reporting. Thank you so much for joining us today and all this week. That is our Bloomberg Chief Wall Street correspondent, Sri Natarajan. Coming up, speaking of access to high net worth individuals, Carlyle's head of private wealth is going to be joining us, Shane Clifford, as they try to court more clients alongside a splashy new sponsorship in Red Bull. That conversation is coming up next. We go live to Matt Miller in Detroit. This is Bloomberg. Let's get to high interest, a look at what's making headlines around the world. Iran appears to have avoided immediate U.S. military strikes after pledging it will not execute protesters. President Trump said that he was informed that killing in Iran is stopping and warned he would respond forcefully if that returned. Iran's foreign minister publicly ruled out executions, saying, quote, hanging is out of the question. While protests have eased, tensions between Tehran and Washington remain high. Elsewhere, President Trump is threatening to invoke the Insurrection Act to send military forces into Minnesota to curb violent protests tied to federal immigration enforcement. Some irony there, perhaps. The warning comes after an ICE agent shot a man in the leg in Minneapolis last night, and 1 week after an ICE agent fatally killed Renee Nicole Good. 4 astronauts have returned safely to Earth after NASA carried out its first ever medical evacuation from the International Space Station. The Crew 11 team undocked aboard a SpaceX Dragon capsule, splashing down off the California coast and ending their mission about a month early. NASA says the unidentified crew member is doing fine, and the medical issue was not related to conditions on the space station. All right, let's send it back to Detroit with Matt Miller. He's over there as private capital forays into the world of sports sponsorships. Matt, take it away.
Yeah, thanks very much. I'm here with Shane Clifford from Carlyle, who has grown Carlyle's wealth business tremendously, but also who is working on this partnership with Red Bull. So I want to start right there because your foray into Formula One has been fantastic for your business. Explain to us how important this partnership is.
Well, first of all, thanks for having me, Matt. You know, it's exciting to be here in Detroit today. The snow is coming down, and it's just a lot of buzz around here. So from my seat, you know, we spent a lot of time thinking about what would be the best partnership for us. And we really landed on F1. And in particular, we landed on Oracle Red Bull Racing. Why? I think is probably the obvious question. From my seat, you know, Carlyle is a global firm. We have clients all around the world. So we needed a partner that had that global footprint as well. That's what we got with F1. I think in particular, what we were really interested in was just the growth of F1 right now. They're up over 800 million viewers right now. There's a strong female base within that. 40+% of the fans in F1 are female. And for us, that brought a lot of excitement and made a lot of sense to us. There's a lot of upside from here, though, still to come.
I want to get to the female bit and also the growth But first, I want to just ask how you use this partnership. It's not just marketing. It's not just, and I saw the livery early. Dani, I saw the livery, and Carlyle is front and center on the side of the car. But it's not only about that, right? It's not just like advertising.
No, I think in today's world, right, where it's so tech-driven and everyone talks about AI and all of that, if you're in my seat, I'm trying to figure out how can I give great, unique experiences to our clients. And in particular, when you look at what Oracle Red Bull Racing brings to us, the way I describe it, let's say for a US audience, would be that this allows me to bring clients into the pit lane, into the garage on game day. So it's kind of like bringing clients into the locker room on Super Bowl Sunday. That has tremendous value. So yes, it's important that we have the partnership, but this really is about the client experience. And we're doing that in various Grand Prix all around the world this year. Super excited about it. The feedback so far has been tremendous for us. We're in the first year of this experience, and it's been just lights out, game-changing for us.
So in your business has grown tremendously, I'm guessing partly because of that and because you can court these wealth advisors, right? It's not like dealing with just Ontario teachers or CalPERS. Like there's a whole new client segment that you've accessed that powers your revenue growth.
100%, Matt. When I look at what we're doing, I go back to when Harvey Schwartz took over at the firm. We've nearly doubled our wealth business in that time, which is just fantastic. A lot of it, kudos to Harvey on that.
And what's your share of revenue? Give us some stats.
When I look at it today, we're on track right now to be about 20% of gross flows at the firm, from a base of about 3 to 4%. So we're trending in the right direction is what I would tell you.
That's more than trending. That's exponential growth, essentially.
Well, growth, what drives growth is performance. And that's something that's at the core of what we do. At the end of the day, bringing institutional private market capabilities to the wealth channel is incredibly important for us, but we have to do that in a really thoughtful and sequential way. So we're going to take our time. We're not in a rush to achieve this, but right now, it's an exciting time for us at Carlyle, in particular in the wealth channel. The growth we're having is exponential. We're very excited about that. But we've got to be thoughtful and careful and judicious as to how we do this.
All right, so that ties back to what you were saying about, there's a younger audience watching Formula One. There's a very female audience watching Formula One. And we're witnessing the beginning of what some call the silver tsunami, right? The boomers are handing off a massive amount of wealth, like $75 trillion, to women and to a younger generation. So how do you prepare for that?
I think what we did was we looked at the Carlyle brand, which is really, really powerful in the wealth channel today. But I think we as a firm as well have to think about what will that brand look like over the next 5, 10, 15 years. And it was key for us with this partnership. A lot of people thought about, wow, Carlyle and Oracle Red Bull Racing, that's a unique pairing. But when you dig in, it makes sense. It makes real sense for me and for the firm and for the C-suite, because what we're trying to achieve is getting that brand in front of those eyeballs. And we get that with F1, we get that with Oracle Red Bull Racing. I would say that silver tsunami is upon us. A couple of years ago, you and I would have talked about this as something that was coming, that was pending. I travel around the world all the time, whether I'm in Japan, if I'm in Singapore, Abu Dhabi, London, New York, Detroit, I'm seeing it real time today. It's happening.
And it happens at the same time as private investments are becoming a much more important part of high net worth individuals' portfolios. We have data that shows when wealth changes hands, especially when it changes hands from male to female, they often really move their investments, right? So how can you, I don't want to say harvest, but how do you take advantage of that opportunity?
I think what you have to, at your core, focus on is education. And that's something that's going to be at the core of what we're doing going forward. We need to connect. At Carlyle, it's all about connections. And from my seat, we need to do a great job of connecting with those new clients and making sure that they understand what we bring to the table, understand the benefits of private markets from a diversification and risk perspective. That's kind of at the core message. But this business is all about trust, relationships, performance, and connections.
We've seen public markets, obviously climb for 3 years in a row here in the U.S. Internationally, they did even better than the growth that we saw in 2025 in America. How do private markets look to you, especially private assets, going forward?
Yeah, I think at the core, for the wealth channel in particular, I think you need to keep it to a very straightforward message. Wealth clients understand the benefits of diversification. And in today's market, the exponential growth of private markets has led that if you wanted a truly diversified portfolio, it needs to have private market investments in it. So, a couple of years ago, I would have said, your average wealth client maybe had a 5-6% allocation to private markets. Today, we're seeing that go up north of 10, on its way to kind of in the range of 10 to 30% now. So I think that alone is going to see tremendous growth for all of us in this business going forward.
All right. It's fascinating. I feel kind of guilty because Dani obviously is really our private markets expert, and she's a super F1 fan. So I feel a little bit guilty about being here, but it's exciting, Dani. So thank you very much for letting me come. That was Shane Clifford, who runs the wealth business for Carlyle.
I love that you feel guilty. That's okay. Just bring me back some Red Bull swag or something, and we'll call it even, Matt. I think that's fair.
Yeah. I'm still enjoying it. I don't feel so guilty that it's ruining my trip.
Good. I'm glad you were able to sleep last night. Hey, Matt, thank you so much. Looking forward to the rest of your conversations. Matt will be joined by Linda Hubbard, the CEO of Carhartt, who also has a partnership with Ford. Again, looking forward to that. That's coming up just in a few moments' time. This is Bloomberg Open Interest. Just under an hour into your trading day, a rally underway, being led by big tech. By the way, big tech was the thing that underperformed yesterday, but the rest of the market did okay. The equal weight had a record day, as did Russell 2000, which is also head for a record. So NVIDIA, Broadcom, AMD, again, all those tech players really helping TSMC. They reported earnings overnight that blew estimates out of the water, especially for their capital expenditures. To the downside, a lot of healthcare not doing well. Eli Lilly down 4.5%. Boston Scientific, they're doing M&A, which means that they're not doing so well. So if you look at what the individual sectors are doing, you see kind of the same thing, right? Tech at the top of the pile, healthcare at the bottom. Healthcare falls 1.5% today. Energy also down as oil falls too. Coming up, Ford announces another partnership to revitalize Detroit. We're going to hear from the Carhartt CEO next. Mexican President Claudia Sheinbaum says the current USMCA trade deal is working for the U.S. and Mexico. Ford CEO Jim Farley does not agree. He spoke with my co-host Matt Miller in Detroit.
Ford is the most American car company. We produce the most hourly workers. We export the most. And so the administration's been great to work with. We've made progress on mitigating some of the tariffs, but we have more work to do. The EPA changes are really welcome, frankly. And we're seeing that play out really in our business. Part of the reasons why our valuation is increasing is because people understand we can build more profitable vehicles now, and that's more employment in the U.S. But there's a long list. We got the USMCA coming up, very important negotiation for Ford. We need to change USMCA, but we built our entire vehicle business as an industry between Canada, Mexico, and the U.S. We have to get this revised, but it'll be very important. I think continue to work with the administration on tariffs, how we handle the China. If you look at what's happening in Europe right now, in the UK, the Chinese are now quickly almost 10% of the marketplace, in electric cars even higher. They pose a lot of threat to labor locally. They have huge subsidies from the government that they're exporting. As a country, we need to decide what is a fair playing field from a cost. How do we handle, these vehicles? If we're scared of a balloon, you can imagine a car with 10 cameras that can drive itself. These are incredibly sophisticated technologies, and when we deploy that in China, it has to be approved by the Defense Department because, those vehicles can be guided into all sorts of things. Well, we need the same, we have a good starting point for that philosophy of the ITC of the vehicle, the digital footprint. Now we have to, make sense of that for the China threat. I know that the president talked about that during his visit at the Economic Club. How do we handle Chinese cars? Now, his personal opinion was we should let them into the U.S., but maybe. I think we need to work through that as a company and as a country.
That was part of Matt's conversation with the Ford CEO, Jim Farley. Let's now head back to Detroit, where Matt is with the CEO of one of Ford's latest partnerships. Matt.
Yeah, Dani, I'm here with Linda Hubbard. She's the CEO of Carhartt, and Ford is working with Carhartt on the essential economy. So, Linda, first of all, thank you so much for joining us.
Thank you for having me, Matt.
I find this to be a fascinating topic, and everyone knows how essential, plumbers, electricians, HVAC, it's really a class of worker that I think America didn't think enough about until the pandemic. And now we're kind of waking up to how important these workers are. What are you doing with Ford?
So this partnership that we've started with Ford, I think we were both separately having the same conversations in our company about what do we do about creating appreciation for these undervalued skilled trades and technical workers in America. How do we try to find ways to make access for people to get involved in the skilled trades and consider it as a career? So we were doing a campaign last year called Made Possible, and we said, we really want to showcase what it is that these people are doing and maybe inspire some younger people to consider joining the trades or consider it as a career. At the same time, Jim Farley and Ford were holding the Accelerate conference, talking about the essential economy, really the challenge that we have of this shortage of skilled trades. 1 million jobs unfilled right now, 2 million by 2030. So as we started to have conversations together, knowing that, scale and, being able to move things forward with like-minded companies, that there was a really strong intersection here. Because when you think about Carhartt and Ford, we've been on the same job site together for each of us for over 100 years.
Yeah.
So just, creating this partnership together where we can focus on workforce development, where we can focus on community building, and of course we have to focus on continuing to make durable products for the consumer that we serve. So we said, let's join forces and see how we can make this happen. And not just create awareness, but actually try to figure out how do we put together focus on training, on funding, on equipment, actually
so
create some
training and
tactics.
Funding and gear. I was going to ask, what are the biggest barriers to a young person who sees this as a career opportunity for life, wanting to get involved in some of these skilled trades?
I think that is. Training is a big piece of it. Like, how do we show people the path to actually getting credentialed? I know Ford has, in particular right now, is focused on their auto technicians and the shortage that they have there. So we've joined with them in trying to help out the scholars that are in those programs, get them the training, provide them some funding and transportation even to get to classes. And then also Carhartt's providing the gear for them when they graduate to really feel good and take pride in the work that they're doing.
We've spoken on this program with Mary Culler from Ford Philanthropy, and I know she works closely with you on this. Tell us about the tool bank, because one of the things young people on the job often need to bring to work with them, and not all the Wall Street people watching us know that, is their own tools, which can be tremendously expensive.
Yeah, incredibly expensive. And so we, Ford and Carhartt, have partnered with Tool Bank USA. They have locations in several parts of the country, several cities, but there wasn't one in Detroit. And we wanted to bring Tool Bank here. Our own teammates at Carhartt and Ford are actually helping to stock the shelves right now as we set up the tool bank, but they'll be providing really professional level tools and training to whether it be community organizations that are doing work in the city or potentially young people that want to get trained on how to use some of these tools and maybe be inspired to have a career in the trades. So we're bringing Tool Bank here, and we'll be able to really, that's part of our community building that we're doing together.
How's the business doing at Carhartt? Because you are a family-owned business in workwear, but it's also become, or it maybe seen a resurgence in terms of fashionability, right? People want to wear a chore coat. People want to wear a trucker coat. And the duck canvas that you make is obviously so famous for these things.
Well, the business is doing very well, and we are really a workwear company, and that's how we started. Our founder actually talks about way back in the late 1800s, talks about our consumers as being world builders. So that's a pretty big calling for us to be able to take care of today's world builders, who are the people that work in the skilled trades and are actually building America and the roads. So that's where our focus is. Everything that we make is work worthy. And we know that other people wear the brand and are attracted to the brand, hopefully because of the authenticity of the brand and the fact that we celebrate hard work, because I think that's something that everybody in America can rally around.
You are also not just working with Ford on the philanthropic effort, but you're building a product with them, right? So far, we've only seen the wheel, but you have an F-250 work truck. Tell us about that.
Yeah, we are very excited.
When do we see the whole
honored.
thing?
I don't know a specific date other than I have been told this spring. So we are really excited for that reveal and that partnership because, again, one of the most important tools a worker has on the job is their truck. And so to have, a Carhartt and Ford truck built together is pretty amazing. And you'll see some of those Carhartt design cues in the interior of the truck. Our designers worked on it with the Ford designers, and so we're really excited for that reveal.
All right, Linda, thanks so much for joining us. Appreciate you here at the Detroit Auto Show. That was Dani. Linda Hubbard, the CEO of Carhartt.
Matt, thank you very much for that conversation. Again, Matt Miller alongside Linda Hubbard of Carhartt. Coming up, TSMC renews optimism in the AI trade after forecasting faster than expected revenue growth. We're going to have more on today's rally. That's coming up next. This is Bloomberg. Shaping up to be a very good day for tech, soaring after TSMC revived the bulls with a strong forecast. Joining us now is Mandeep Singh, Global Head of Technology Research at Bloomberg Intelligence. Mandeep, it's a TSMC that's been known to be conservative with some of their outlooks. So when it talks about like $56 billion as a high end for capital expenditures, should we assume that that's also conservative?
Not really. I mean, I think the bogey was 40 billion up until last year, so clearly they are going up. And to my mind, what's really showing up in their results is the pricing power. Because so far we saw pricing power with NVIDIA's chips, but it didn't really show up anywhere else in the supply chain. Now this year we have seen memory prices go through the roof. These results show even the fab prices are going up, and that's driving up their gross margins. So really, across the supply chain, you're seeing that lift in ASPs, which is very representative of a super cycle, in the past. And
does that mean, though, when I look at these earnings and say, okay, who else are they good for? That, obviously great for those chip producers, great for the memory chips, which had a bad day yesterday and rallying today. Does it also suggest that it's great for the hyperscalers, or is it just like they're the ones who are spending and it doesn't necessarily mean that that's going to pay off?
Yeah, it may be great for the hyperscalers if that translates into higher cloud rents that they can get from their customers. So right now, if you are a product company like an Apple, or if you're a cloud company that has to get all these components, get everything ready, and then sell the product, you want to see a lift in your ASPs when you sell the product. So in the case of hyperscalers, when they rent out those cloud instances, you want to see a lift in pricing, which I think they will command. So this earnings season, I do expect them to guide, cloud revenues accelerating going forward, because everyone right now wants compute. That's what we have been hearing from Jensen, from TSMC. And if you want compute, you consume it through the cloud. Well, the cloud companies should be able to raise prices as well.
So does this also change how you're thinking about NVIDIA earnings coming up, when they do come up?
I mean, Jensen said at the CES Financial Analyst Q&A, demand is really strong at least 10 times. So if that is any indicator, and now we are seeing that follow through in TSMC's earnings with advanced nodes, 77% of their revenue. So clearly the demand has accelerated. And right now we are in an environment where all these companies that have those chips or are linked to that supply chain seem to be benefiting.
As the cost of memory gets more expensive, what does it mean for smartphone makers, for Apple, because of the consequences of the demand coming from AI? Do they face more prices and maybe more of higher prices, rather, more margin squeezing?
Yeah, so if you think about memory in the bill of materials for an Apple's phone, a $500 cost of that phone would include 10% memory cost. So if the memory prices are going up, that will impact. But remember, NVIDIA and Apple, they have long-term agreements with their suppliers. So in the case of Apple, I bet you they have some long-term agreement that, the suppliers can't really pass on those price increases to the big players. So that's where I think the big players may be slightly less impacted than the smaller hardware companies that clearly will have to pay, or they may not be able to even procure the memory or storage in some cases. So they may be delayed in terms of making that product.
But by the way, what do you make of the reports, and it's something that Mark Gurman had talked about too, that Apple ended up choosing Gemini to power its Siri versus ChatGPT? I mean, Apple is kind of like a big gatekeeper for a lot of these consumer products and how we use it. Do you think that kind of changes the dynamics of the race between the two?
Absolutely. I think this is a clear sign that, one, Apple will have a revamped Siri, and they want to do it with Google simply because they have an existing agreement on search. And to my mind, they will focus on voice here because voice is something that not a lot of large language model companies have focused on. And it's a perfect use case if you're thinking about AI agents. Like with low latency, that could really take off.
Yeah, I'm excited. Like that's what I want on my. I want to be able to be like, hey Siri, can you go make this appointment for me somewhere? I mean, I feel like that's the dream.
Or even through your AirPods.
True.
Imagine if you could talk to your
AirPods. Well, can't AirPods already do live translation?
They can do translation,
stuff like that?
But what if you can talk in terms of a full-fledged assistant? That would be cool.
Yeah, just everyone's going to be talking to themselves more. What a cool future we're heading towards. Mandeep, thank you so much for joining us. Mandeep Singh of Bloomberg Intelligence. All right, some of the single stocks moving this hour. Fannie and Freddie, they are tumbling for a second straight day. Investors are assessing President Trump's push to address housing affordability and that $200 billion spend coming from them. Boston Scientific, they're going to be buying medical device manufacturer Penumbra in a $14 billion cash and stock deal. Boston Scientific falls, Penumbra rallies, and Eli Lilly, they are lower. Reuters reporting that the FDA, they are having delays to drugs that are part, ironically, of a new fast-tracked voucher program. Shares fall 4.7%. Coming up, the rebirth of the largest rail station in Detroit, helping to revitalize the city. The acting CEO of Michigan Central will be joining Matt Miller live in Detroit next. This is Bloomberg.
Hey, Matt Miller here. I'm in Detroit at the Detroit Auto Show with Carolina Pluszczynski. She runs Michigan Central, which is a kind of a separate thing, obviously, from the Detroit Auto Show. You're a 30-acre campus. Bill Ford was really interested in starting this innovation platform with you. Carolina, tell us about Michigan Central.
Yeah, so Michigan Central was created to actually drive innovation and advanced technologies. And we do that through in the areas that are most that Michigan and Detroit had extreme leadership in. So manufacturing, mobility, clean tech. And the companies that are coming here are all working on those real world problems. And so what we do is we provide in our 30 acres the infrastructure that actually enables these startups to succeed. We have about 18,000 square feet of product development labs. We have companies can build their prototype here. We have real world testing environments, so we expedite to get to commercialization faster, and we shorten those innovation cycles because these companies can get a permit within 24 hours and test in the streets. We have community around us that participate in some of the testing and give them that feedback. You know, we pull the talent from the universities. Michigan has a deep R&D talent in automotive and technology, and so we pull that talent here to help these companies grow.
And so as I said, Bill Ford, this is his initiative, or the Ford family and the Ford Motor Company initiative, but it's not Ford specific. You don't have to be related to Ford to work here. In fact, I imagine somebody from Dodge or from Chevy could come and do something here as well, right?
We don't want you to be just from Ford. Ford Motor Company, you're absolutely right. They underpinned the investment because Bill Ford thought it was important to the future of innovation was really about collaboration. And so we are an open platform. The startup companies that are all coming here have formed their own companies, but what they're looking for are, they need industry. They need that first customer. They need to get their product to a place where the companies can then either bring it into their own products, they can bring it into their manufacturing plant. And so, we are welcoming industry here. We actually have some key folks already. Cummins has a footprint here. Ford Motor Company does. General Dynamics Land Systems has a footprint here. And it's not their whole company. It's the pieces of the company that would benefit most from the proximity to the startups.
So it's essentially mobility and defense, though, are, I guess, the focus so far. I've heard you've got drones flying around here.
So it's mobility, all forms. It's clean tech, the advancements of EVs and sustainability.
Important to go forward.
That's right.
Yeah.
And manufacturing. But advanced aerial systems are part of mobility, and we actually are uniquely positioned to help with that. Because of how tall this building is, we have an operations center on our 12th floor, which allows you to see for 3 miles. So we have 3 miles of protected airspace where we can fly drones. We've had about 1,000 flights this year, and that's so that we can get to the point where you can get beyond line of sight waivers from the FAA. And if drones are going to be part of the industry moving forward and part of the supply chain, then we have to be able to help them get there.
We have a story on the Bloomberg that, or people are starting to notice at Bloomberg, and I think Torsten Slok was writing this morning about a renaissance in manufacturing. And obviously the Big Beautiful Bill was aimed at that, but it's not just tax incentives that are going to help bring manufacturing back to the U.S. So is that a key part of your mission?
Yeah, absolutely. And I think that's what Detroit is great at, right? We know how to manufacture at scale, and that's what attracts these companies here, right? They're 1 or 2 people, but as they grow, they get to, we have a company that's on their 100th prototype. Now they need to figure out how to scale. And we were able to, in this one case, partner Ford with the startup that actually helped them get their casting process down from 30 hours to a half hour, and they're able to help them expedite that. And that's what's pulling the companies here, is because of the deep understanding of automotive, of manufacturing in Detroit.
All right, Carolina, great to spend a little bit of time with you, and we really appreciate you hosting us in this fantastic building. Carolina Pluszczynski there is the CEO of Michigan Central. And Dani, it's interesting. I mentioned the Torsten Slok note that I'm sure you saw this morning as well. So much focus on bringing manufacturing back to this economy, so much focus in spurring that. It's obviously a mission that takes time, but with companies, or I should say organizations like this, they really help to spur it along beyond just R&D tax incentives.
It's something that takes time, and to be clear, takes time beyond 4 years, aka a presidential cycle. Matt, you're also having so many more conversations there. I'm personally very pumped for Max Verstappen, I have to say. I think that's going to be the highlight. I don't know if it's a highlight of your day, but it's going to be the highlight of my day is watching that one.
No, I'm really looking forward to it because I think he is probably the greatest race car driver in the world right now. And I'm sure, seen stories that Red Bull and maybe Mercedes have found a little bit of a loophole in the new regulations. So they have this variable compression piece of their engine that Formula One has called an emergency meeting to address on January 22nd. I'm going to ask Max about that. I'm going to ask him how important it is that this car win races from day one, or if he expects this season to be a little bit about learning. But I'm just pretty excited to do that interview and to get deep into Formula One in 2026.
I want to know whether he and Lando Norris are still friends. They've historically been really close friends, but it was a big rivalry. So maybe you can get some of that too. Hey, Matt, we're really looking forward to those conversations. That's what's coming up for Matt Miller. For this show tomorrow, we're going to be hearing from Sarah Hunt of Alpine Saxon Woods, Thrivent CFO David Royal. Plus, we'll have that conversation with F1 driver Max Verstappen. This is Bloomberg.